All right, so today we're going to be introduced to the account, And you already know the names of the accounts. So when it says here, there's a title of an account, well, those are the names of the accounts that you've already been learning about, such as cash or supplies. Those are titles or account names. Accounts payable, notes payable, common stock, service revenue, rent expense are all account titles. So when we're looking at accounts, we have the account title is the first thing we see. And then accounts basically have two sides, okay? There's a left side in the account, and there's a right side to every account. Now, the good news is, all accounts have two sides. Doesn't really matter what the account is. All accounts have a left side and a right side. And only two things can happen in an account. You can either have more of it or less of it. So in essence, think about like your savings account. Only two things can happen in your savings account. You either put more money in, right? So in other words, you add to the balance that's already there, or you take money out, or you reduce the balance, right? So only two things can happen to your savings account, either have more or less in it. Well, the same thing for all of the accounts we've looked at in, so far in this book. Only two things can happen in the accounts. We can have more of them, more of something in an account, or less. So let's just get a couple of terms out of the way as well. And I really need you to forget about what the banking system has taught you. Okay, I'm not teaching banking here. We're teaching accounting. The banking system uses these terms, and you have to forget that how they use it is not how we use it in accounting. Okay, the left side of an account is called the debit side. Okay, so the debit side is simply the left side of an account. All accounts have a left side, so all accounts have a debit side. Okay, because an account has two sides. The right side of the account is called the credit side. That's all that means. Credit is the right side of an account. Debit is the left side of an account. Since all accounts have two sides, all accounts have a debit side and a credit side. Okay. Accounts are like coins. You know, when you flip a coin, it doesn't matter if you're flipping a penny, a nickel, a dime, a quarter. You know, if you flip a coin, it's either going to land on one of two sides. It's either going to be heads or tails, right? Same with accounts. Accounts are either the money or the number is either going to be on the left side or the debit side, or the right side, which is the credit side, because there's only two sides to the account. Okay. Now, with that said, we have to understand that accounts like assets, cash, for example, cash would be a title of an account. Asset accounts increase on the left side or the debit side. So every time we say we have more cash, that means in accounting, we would say we're going to be debiting cash for the amount of money that we just received. A debit to cash is on the left side of the cash account, which is the side that it increases. Assets increase on the debit side. The debit side is the first of the two sides, almost like heads versus tails, right? And all asset accounts, cash, accounts receivable, supplies, equipment, all assets increase on the left side or the debit side of an account. If you look at the balance sheet equation, right? Assets equals liabilities, the stock equals equity. Assets are on the left side of the equation. It's the very first thing we put down. So the left side of the account is the very first side of the account you see. Assets increase on the left side corresponding. So if we say we have more cash, say we had $10,000 more in cash, in accounting speak, we would say we're going to debit cash 10,000. To an accountant, that means we have more cash. If an account like cash increases on the debit side, the other side means it's decreasing because there's only two sides to an account, right? One side increases the account, the other side decreases it. So for asset accounts, the left side or the debit side shows that we have more of it, which means the opposite side, the right side, the credit side, means we have less. Okay. So for all asset accounts, cash, accounts receivable, supplies, prepaid insurance, equipment, etc., the left side means more. The right side means less. Increase, decrease. That's something you have to know. Okay. Let me go down here. You'll see that our Sierra Corporation, we had a lot of activity in cash in Sierra Corporation from Learning Objective 1, right? You remember that we had more cash for the very first event because the stockholders put cash in, right, for common stock. We had more cash in the second event because they took a loan, so they just got a bunch of cash, more cash in the cash account. And then they used that money to buy equipment. So here we see there's less cash in a cash account. This is how you analyzed it, and that was a big part of your homework. Now we need to do one further step. How do accountants see these things in the cash account? Well, again, like I was mentioning, this $10,000, which the investors put in event number 1, meant we had more cash, and you all kind of seem to get that. Well, to an accountant, to bookkeepers and accountant, it would be a debit to cash for 10,000. Again, cash is an asset account. Accounts have two sides. The left side is the debit side, the right side is the credit side. For asset accounts like cash, the debit side is the increase side, shows we have more. So you analyzed it as plus 10,000 in Learning Objective 1, that we had more cash. In reality, we actually talk like this, $10,000 debit to cash, which also means we have more cash. But this is how bookkeepers and accountants talk, okay? When we got that loan for $5,000, we got $5,000 of cash. We also had more notes payable, as you might remember from event number 2. Well, that more, we analyzed it and we said we had more cash. Okay, $5,000 increase in cash. Well, in accounting speak, we say we have a debit to cash of $5,000. We have more cash. We have more cash. Now, again, if the debit side of the account, because the account only has two sides, so one side of the account is going to increase. In this case, the debit side increases asset accounts. So when we actually need to use cash to buy something, we say goodbye to that cash. In accounting, we use the credit side of the account. The credit side of the account shows less of cash. So when we use this $5,000 of cash to buy the equipment, okay, then the proper way we viewed it is a credit to cash for $5,000, because the credit side, the right side of the cash account, shows less money. Okay, shows less money. So this is how it's done for cash. All assets work this way. It's just the opposite for liabilities and stockholders' equity, as you're going to see very shortly. liabilities and stockholders' equity accounts, like accounts payable, which is a title, right, of an account, like common stock, right? They actually increase on the right side. And that makes sense because when you look at the balance sheet equation, assets equals liabilities and stockholders' equity. Liabilities and stockholders' equity is on the right side of that equation. So think about on the right side of their accounts is how we say we have more. So more notes payable would be a credit to the notes payable account. That means we have more notes payable because the credit side of a liability account shows increases. When we pay that note off, we would debit that account to show it's decreased. Again, accounts only have two sides. One side increases it, the other side decreases it. For assets, which are the first, right? Assets equals liabilities. It's the first thing that we talk about. The very first column, the debit side, increases all the asset accounts. Doesn't matter what the name of the asset account is. The debit side is the increase side. The opposite is true for liabilities and stockholders' equity accounts. The credit side is the increase side. Okay. So with that, I'm going to take you to the PowerPoint so we can start practicing this type of stuff. And I'm actually going to be calling on you to talk to me like an accountant, and we're going to practice this today. And again, it's something that it'll get easier with time. It's just like something new. Every time you're introduced to something new, you start scratching your head and like, what? But after a while, it's like, oh, okay, all right, I think I catch on. And so today is the day we start that journey, that new bicycle ride here. So let's go to the PowerPoint. And just to double check, you all are seeing the PowerPoint slideshow in front of you now? Yes? Yep. Okay. My pen here and off to the races. So learning objective 2 is more analysis, but this time we're looking specifically at an account, at the account. Every account has two sides. Again, go back to your savings account. Only two things can happen in your savings account. You can either have more savings or less savings, right? When you put money into the account, you say you have more. But when you take money out, you have less. Well, those accounts, all accounts have two sides, a debit side and a credit side. Okay. And so one side increases the account, the other side decreases the account. It's just a matter of understanding that assets are different than liabilities to stockholders' equity because they increase on opposite sides. And that's part of what we're going to be learning today. Also understand that we still have a double entry system. In other words, you learned in learning objective 1 that every transaction affected two accounts, right? At least two accounts were affected. Well, that also means that two accounts are going to be affected this way. And so one account is going to be affected on the debit side of its account. The other account is going to be affected on the credit side of its account. So just like we did in learning objective 1, an equal number of accounts is affected. In this case, the debit side of the account and the credit side of another account are going to be equally affected. And you'll see that. So again, I don't particularly care for this slide, but I'm going to go ahead and make this the cash account. In my wonderful way of writing with my finger on my getting old to be laptop. So in this case, this is a cash account, and asset accounts, and of course, all accounts have a debit and credit side, but asset accounts increase on the debit side, the left side. Asset accounts decrease on the credit side. DR is short You'll see this shortened for debit, CR for credit. It's hard to understand how they got the DR from this, but I think it goes back to the original word, either in Italian or then Latinized to some degree or another. And that's how they got the DR and the CR, sort of abbreviating from the original term from the Latin or the Italian. Because actually accounting sort of started in Italy. Okay. All right, so here you have 3 transactions that happened. All of these are separate transactions, and all you're seeing is what's happening in the cash account right now. So as you see, transaction 1 was a debit to cash. Now, debits to cash mean more cash. So this is clearly an increase in the cash account. Transaction 2 was a $3,000 credit. Well, the credit side of cash means less cash. Okay. So you think about it. If you had $10,000 of cash to begin with, and you took away $3,000, you have $7,000 left. Yes. Transaction number 3 is you put $8,000 back in. So again, a debit side means more. So your balance in the account is $15,000. That's because, again, the debit side is the increase side. So all of these are increases in the account. The right side, in this case, the credit side, is the decrease side. This shows money going, in this case, this is cash going out. This is cash coming into that account. Okay. So if you have $18,000 of money going into your savings account and $3,000 of money going out, the balance in your account is 15. But specifically, balances fall on either the debit or credit column. There's no balance in the middle, right? So in essence, what we have here is when we actually say the balance of an account, we actually also have to say the side that the number is on. So if this was indeed the cash account, and I asked you, what's the balance in the cash account right now? You would tell me it's a $15,000 debit balance, right? Because it's the balance is on the debit side. Okay. So we would say it's a $15,000 debit balance. Okay. And it would be true. Again, we use the actual side of which where the balance is on to state what the balance is. Again, not liability accounts, stockholders' equity accounts, like common stock and retained earnings, are going to have balances on the opposite side because that's how we show more. Okay, and you'll get used to that in a minute. Well, more than in a minute, but you know what I mean. All right, so I'm going to go ahead and now this here, let's say this was a let's say this is a retained earnings account. I'm just going to put RE here because by the time I write the whole thing, the class will be over. So let's say this is a retained earnings account. And again, there's still 3 transactions. There's a $10,000 debit transaction and 2 transactions on the credit side. So retained earnings is a stockholders' equity account. Stockholders' equity accounts are on the right side of the equation for the balance sheet. Right? Assets equals liabilities of stockholders' equity, far right side. So the right side of their accounts is how we show more. Okay. So we have 11,000 in total. These two would say have $11,000 in credits that happened in this account. But the debit side of the account, the other side of the account, again, only 2 things can happen in accounts. They either go up or down. That's it. Okay. More or less. Increase or decrease. Whatever terms you want to know. It's fine. So in essence, we're taking away this $10,000 on the debit side. So the balance in the in this particular account, if I asked you what's the balance in retained earnings right now, you would tell me it's a $1,000 credit balance. Okay, credit balance because it's on the credit side. On the credit side, and you'll get to learn this particular objective. You'll learn how to do those balances. All right. So in essence, there's a lot of little things in your book that try to explain as best they can that, again, asset accounts increase on the debit side, decrease on the credit side. Liability accounts increase on the credit side, decrease on the debit side. And so that's, again, these are all things that we're learning. The weirdest account, as you know, is retained earnings. Because as you know from the first learning objective, we sort of look at retained earnings in a broad context. The retained earnings account absorbs, as you know, the income statement accounts. Revenue and expenses give us net income, which ultimately end up in retained earnings. So in essence,
I actually have a question.
yeah.
Since usually that on the left side there will be a positive number, and on the right side it will be a negative number. What happens if
There's
what
no
happens if
positive. We don't say positive or negative in accounting.
I know, but I'm just saying. But I want to ask, what happens if it's zero?
Well, then there's no balance in the account.
Okay,
I mean, if you
understandable.
open up a savings account, you put $100 in, your balance is $100. But if you take $100 out, your balance is zero. So
Mm,
accounts can have a zero balance, but they can never go below zero.
mm,
Okay, you can't have negative savings in your account, can you?
you can't.
In your savings account? No. So the same thing here. You can't have negative cash. You can't have negative. There's no such thing. We can only have a balance either on the debit or credit side in all the accounts.
Oh, okay.
As you'll say, and we're going to be doing more of this, and I think it'll help. Retained earnings, as you know, is the really interesting account because, like I was saying, the revenue accounts and the expense accounts and the dividends accounts are ultimately absorbed in the retained earnings account. Okay. Notice that stockholders' equity, also being on the right side of the equation, increases on the credit side. Okay. They increase on the credit side. So you have to start thinking about, well, all right, so retained earnings, the more retained earnings we have, it'll show up on the credit side. Well, what can take away from retained earnings? Well, we already know dividends take away from retained earnings. So dividends are shown on the debit side of the account because the more dividends we have, the less retained earnings we have. And the same is true with expenses. Okay, expenses work the same way as dividends. The more expenses that we have, the less retained earnings we have. Okay, because in essence, they both take away from the profits of the company. All right. So again, this is what shows here. Revenue is where the profit is. Revenue ultimately gives us net income, which is ultimately added to retained earnings. So again, like retained earnings, revenue increases on the credit side of its account. However, the more expenses we have, the less profit we have. So expenses are going to show up on the debit side because the debit side for retained earnings shrinks it. Same with dividends, as you saw. So I would say that one of the most important, this is the one I like the most. This particular illustration is on page 105. Page 105. Again, I'm writing with my finger on a older laptop. Doesn't work out too well. So this particular illustration is really, really good because it simply is the summary of how accounts increase. So here's the basic equation I was telling you, right? Assets are always listed first. So in essence, assets are on the first things that are listed, so they increase in the very first column. All assets, regardless what the name of the asset account is, like I said, cash or supplies or equipment, are going to increase in the very first column, which is the debit column. Assets are on the left of the balance sheet equation. They increase on the left side of the account. Liabilities and stockholders' equity are on the right side of the equation. And so they're going to increase on the right side of the accounts. So all the liability accounts increase on the credit side. common stock will increase on the credit side. Retained earnings increases on the credit side. Now, this is the strange one, right? Because as we looked at in objective 1, retained earnings absorbs the income statement and the retained earnings statement all into one. So the profit of the company comes from the revenue. So very much like the retained earnings account, revenues increase the profits of the company. And so revenues are going to be looked at as credit side balances. However, as you know, expenses take away, dividends take away. How would we take away from the retained earnings account? Well, the takeaway is on the debit side. And so expenses are debits because expenses take away. Dividends are also on the debit side because they take away from retained earnings. So it's sort of how these fold into that account again. That folding is important to sort of understand from the first objective. Okay, so what I'm going to do is I'm going to go back here to our transaction analysis from Sierra Corporation. So can everyone, I didn't mean to make anybody dizzy, but can everyone see that now we are back on event number 1 for Sierra Corporation? Yes, yes? I can't see you. Let's see. Yes, okay, good. All right. So here's our trick today. We're going to take the information we learned in objective 1 and apply it to the debit and credit side of the account. And we're going to be talking, and everyone's going to get a turn. So it's not like you can wiggle out of this stuff. I want you to learn. And I think the only way to learn this stuff is by doing it. And so we're going to do it. Again, I'm channeling my inner Canadian today. So we're going to do it, right? But we take all that cold air. We're going to do it. Let's do it. Okay. So here is our first event. On October the 1st, cash of $10,000 is invested by the investors in exchange for 10,000 common stock. We analyzed this in objective 1. We said we had more cash and we have more common stock. So now this is how we analyzed it. Now what we need to do is apply that debit and credit analysis to it. We have more cash. How do we say we have more cash? What side of the cash account is affected to say we have more of it? Open question. Oh, we have a text here. Okay.
We're going to debit the cash account for $10,000.
Right. So the cash account, more cash indicates the debit side of the cash account is going to be affected because the debit side of that account shows more. So a debit to cash always means more cash, right? And here we have more common stock. Common stock is a stockholder's equity. Again, assets are on the left, liabilities and equity is on the right. And so how would we say we have more common stock, right? So here, Clark is writing, we credit the common stock account. Again, common stock account, like all these accounts, have 2 sides. They all have 2 sides. It's a debit side and a credit side. It's just a matter of, in this part of the chapter, what side is affected by this transaction? And that's what we have to name. And then we're talking like accountants. So how we would talk like accountants in this is we're going to debit cash 10,000, credit common stock 10,000. Notice the debit side is affected on one account, the credit side is affected on the other account, and they equal. Right. So that's what this was talking, that it's a double entry system. Both the debits and credit side are going to equal. All right. So that was nice. And we're going to keep going because I know you just can't wait to have this much fun. Event number 2, I know you've been looking forward to this all weekend. Like, yeah, all right. Woo! We're going to talk like accountants this week. Damn. I'm ready. All right. So also on October the 1st, as you remember, Sierra Corporation borrowed $5,000 from Castle Bank by signing a 3-month, 12%, $5,000 note payable. We analyzed this. We said, okay, we have more cash for sure, but now we have more notes payable. So just as a way of moving things around here. Adam,
I
talk to
think
me about
that's
the
also credit. I think that's also credit.
Well, hang on. So let's look at the cash account and see what happened there. Tell me what happened there on the cash account. If we had more cash, again, assets are on the left side of the equation. So remember, they increase on the left side of their accounts. Liabilities and stockholders' equity accounts are on the right side of this equation. They increase on the right side of their account. So just talk to me about cash. How would you explain that we have $5,000 more in cash? Talk to me like an accountant in essence.
I don't know. I don't know. I just do the work. I'm sorry.
What side of the account? What side of the cash account tells us we have more?
Assets.
No,
Debit.
accounts only have two sides: a debit and credit side. What side is affected on the cash account when we say we have more?
Credit.
No.
Debit.
Well,
I'm sorry.
that's the only other option you got. I mean, if you need three chances, I mean, it's maybe not your day, for sure. But anyway, yes. So remember, I think you should have that chart in front of you as you are doing this. I don't want you to think that you're going to memorize all this stuff up front. Okay, I really just don't. And as I may just put down here, light bulb, we're going to credit the notes payable account by $5,000. Notes payable is a liability account. Liability accounts increase on the right side. Remember, all accounts have two sides. The left side is the debit side. The right side is the credit side. So we're just putting these things together. Cash is going to be debited by 5,000 because we have more cash. Cash is an asset account. Asset accounts also have two sides, and the left side of their account mean more. So a debit to, thank you, a debit to the cash account for 5,000 means more cash. Credit to notes payable for 5,000 means we have more notes payable. Okay, let's keep going. We're gonna get this. Yeah, by the time we have lots of transactions to do, you're gonna be like, oh yeah, I get it. I mean, literally. I mean, within the next, what time is it now? I'd say within the next 20 minutes, more light bulbs are gonna go on. Okay, more light bulbs are gonna go on. Of course, your electric bill will be higher, but anyway. Oh, I mean, we have to just, we can't write this stuff on here. Let's see if I can erase. Oh, thank you. Thank you. Okay. All right. So event number 3 here is Sierra Corporation purchased equipment and they bought the equipment with cash. So in this case here, we have 2 asset accounts are affected. We analyzed it. We said, okay, we have a lot more equipment, but now we have less cash. Remember, only 2 things can happen in an account. Either have more or less of it. It's either going to increase or decrease. So let's go down here. Let's see, Miss Felice. Talk to me like an accountant. What just happened here? You have to unmute yourself. Hang on, let me see if I can. Can you unmute?
Okay, so we're crediting equipment 5,000 and we're minusing.
There's no minusing.
No minusing, okay.
Again, there's only 2 sides. It's either going to affect one of the 2 sides. So it's either going to be on the debit side of an account,
okay,
credit side of the account. We already know what it does once it's on the side. So I hate to say it, but you got to pick sides. So you just got to pick sides in this fight.
okay, so we're crediting equipment 5,000.
Okay, so in all asset accounts, whoops, you still with me? Okay. Asset accounts have 2 sides, right? All accounts have 2 sides. The debit side, which is the left side of the asset account, show increases.
Okay.
The opposite side of the account shows the decrease. So look at what we just did earlier. In the first transaction, we said we debited cash 10,000 because we have more cash. In the second transaction, we debited cash 5,000 because we had more cash. So the debit side of the cash account shows more cash. So here we're saying we have less cash. So what side of the cash? There's only two sides. One side increases it, one side decreases it.
So we debit 5,000 from cash.
No, that means we would have more.
Because okay, so you're saying we credited 5,000 equipment, so
No,
how
we
do
didn't
we
credit-
minus?
I didn't agree with that either.
No, okay, well.
Agree with that either. I'm just looking at, let's just take one at a time. Again, assets increase on the debit side, they decrease on the credit side of their accounts.
Mhm,
Okay.
okay,
So if we had, and we'll get to the equipment account in a moment, but let's just go back to cash for a second. Okay. Like I said, in transaction one, we had more cash. So the correct response was debiting cash.
okay,
That's how we say we have more cash. In the second transaction, we had 5,000 more of cash. The correct response, debit to cash.
mhm,
Debits to cash account mean more. Debits to asset accounts, no matter what their names, mean more. Here we have less cash. So if the debit side of the cash account means we have more cash, and accounts only have two sides, what's your choice?
but you're saying we're not talking about equipment, we're talking about money now?
Of course.
Okay. So equipment is an asset account as well. And if you want to talk about equipment, let's do that. We have more equipment. So let's start with equipment. How do we say we have $5,000 more of equipment? What side of the equipment account will the $5,000 go in?
Debit?
Debit.
Okay. So we have a debit to equipment for 5,000 because we have more equipment.
Okay,
Now, how do we say we have less cash? Because we used $5,000 of cash.
Credit to cash.
Okay, Adam, yes, that would be correct. The credit side of the cash account means less because all of these were debits. The 10,000 was a debit, which is an increase. 5,000 was a debit, which is an increase. So if these are increases, how do we decrease? Well, accounts only have two sides. So one side increases the account, the other side decreases the account. For assets, the left side, the debit side, is the increase side. So that means the credit side has to be a decrease. So, okay. We're going to keep going. I'm sorry?
For each transaction, you want the debit and the credit sides to balance.
Well,
So
you
it's always
want an
5,000
equal
and
number, right? So
5,000.
if one account is affected on the debit side, the other account is going to be affected on the credit side. Okay, because you have to have an equal number on both sides when we're all said and done. The debit side and the credit side of different accounts will be equal. Will be equal. Okay. All right, we're going to move on. Event number 4, and again, this is all new and exciting, so it'll take a while, but you'll get there. Here we received $1,200 cash advance from the client, our Knox, right? So we analyzed this. As you see here in transaction number 4, we said we had more cash, but now we have more liabilities in the form of unearned service revenue. So let's see if, Megan, how about you giving this a shot? Tell me how the cash account's affected and how the unearned service revenue account's affected by using that debit credit analysis that we just learned. Give it a shot.
Oh, okay, so we have a $1,200 debit in the cash
Yes.
balance, and then we have a $1,200 credit in our liabilities and unearned service revenue.
Specifically unearned service revenue. So yeah. So it's a matter of naming the account. So cash account, unearned service revenue is the account name, right? And then what side is affected in each. So again, cash is affected on the debit side for 1,200 because we have more cash. Assets increase on the debit side. Unearned service revenue is a liability account. Liabilities increase on the credit side. So the $1,200 credit to unearned service liabilities would tell us automatically that we have more of that liability. Okay. So this is how, that's why we don't need to use pluses or minuses or positive or negative. We don't do any of that. It's either on the balance is either on the debit side of an account or the credit side of an account. That's it. That's how we talk. And that might take a little bit of getting used to, but that's where we're heading. Okay, that's the goal. That's where we're going. Mhm. Nice job on that. All right, event number 5. Now this is interesting because in this case, it's the very, very first time we received cash for services performed, which is revenue. So obviously we have more service revenue and we certainly have more cash. And so knowing this, let's see, Ava, you want to give it a shot? I know this is not, I mean, this is all new and exciting. Talk to me about what happened here.
Okay. So I would start with 10,000 debit to cash.
That's perfect, right? So we have more cash, $10,000 debit to cash. So you know that the debit side is all set. The other account has to be affected on the credit side.
So the other one should be credit, but in this case, I am not sure.
Okay. So the amount, the actual account that was affected by this transaction was service revenue.
Yes. So we have actually more.
So the service revenue account is going to get a credit for 10,000. Okay, because we have more service revenue here. So service revenue is the source of the profits for retained earnings. Retained earnings as a stockholders' equity account increase on the credit side. So revenues are directly related to that. So all revenues will show up on the credit side.
Okay.
Okay. So a credit to service revenue for 10,000 is how we finish it. Debit cash 10,000, credit service revenue 10,000. That's exactly how bookkeepers and accountants would talk to each other about this. Nice job. Nice job. Okay. Event number 6. Ooh, this is a toughie. We paid rent for $900 in cash. We analyzed this. We said, okay, if we paid rent, more expenses mean less retained earnings. And then, of course, we pay our rent by cutting a check, and so cash is affected as well. Less cash. So this is a toughie. Let's go. Let's see. Who'd like to tackle this one?
I think it is. I think for the cash side, it's going to be in the credit. It's going to be the credit side.
So it's a credit to cash for 900 because we have less cash. So you're right. That's it. So where's the debit going? What account is the debit going?
I think it's going in the credit or expire.
Right. So you, again, you already used your credit here.
Oh, so you use debit
For what account?
for the
Yes.
expire. Because like I noticed it because
What's,
like this.
what's the account? What's the account called if we paid rent? What's the title of the account if we paid rent? It's not expenses. That's not even an account, right? We have names of accounts.
Return earnings.
No, it's rent expense.
I'm sorry, I didn't know.
Oh, it's okay.
So,
Well, again, as I mentioned many, many times, we have to be specific when we list the accounts, right? In order to do accounting, we have to know the accounts. So rent, when we pay rent, that's a rent expense. Okay. So the rent expense account would get debited for $900, right? And cash would get credited for $900. Expenses as well as dividends shrink retained earnings, right? Revenue increases retained earnings. So to increase retained earnings, that's why we credited the revenue account, because credits increase retained earnings. Expenses and dividends shrink retained earnings, bring it down. And so that's why they're on the debit side. All expenses and the dividends accounts whenever they're affected, they're going to be on the debit side because they shrink retained earnings. That's their ultimate effect. Right. All right, so let's keep going here. Event number 7 happened when Sierra Corporation paid $600 for an insurance policy. We analyzed this. We said, okay, we have more prepaid insurance, but we used cash, so we have less cash. So let me go ahead and see if we can find new voices. Nick, you want to give it a shot? Talk to me like an accountant, Nick. We have more prepaid insurance. We have less cash. Is Nick there? All right, how about Cassandra? Are you there?
I'm here.
Okay. Give it a shot. Talk to me like an accountant. We just have more prepaid insurance. We have less cash by 600. Tell me.
So the prepaid insurance would be the debit, so it would go under assets.
Well, we don't. Yes, the debit to prepaid insurance. So we don't have to worry. We know that prepaid insurance is an asset account, so we don't have to mention that, right? So a debit to prepaid insurance means the prepaid insurance account is affected on the debit side by 600, which is the exact say. That's like saying we have more prepaid insurance.
Okay.
Okay, and
What's the second part?
yeah, that is the second part. We have less cash by 600.
Okay. Okay.
So how do we say that? What
I
side?
don't have no.
Okay, that's okay. So who wants to chime in?
Credit to cash 600.
There you go. So again, we're going to have for every debit we have, we'll have an offsetting credit. So in this case, she identified the debit to prepaid insurance correctly, right? We have more prepaid insurance. So the debit to prepaid insurance means more prepaid insurance. The offsetting credit is this case going to cash.
Okay.
Okay. So the credit of $600 to cash tells us we have less cash.
Okay.
Good. All right. Let's keep moving along. And you guys know this is hard work. This is why bookkeepers and accountants they make a good amount of money. This is not easy. Right. All right. So on the 8th, the 8th event happened on October the 5th. They bought a whole bunch of supplies on account. Remember, on account means they got a bill. They got to pay later. So look what happened. We analyzed it. We said, okay, we have more supplies by 2,500, but now we have a bill to pay. Now this bill is an accounts payable, so we have more accounts payable. So who would like to tell me? And again, new voices are encouraged. What about the other Megan?
So you would debit supplies and credit accounts payable.
You got that right, but you also have to, whenever we talk in accounting, we're going to say the amounts with that. So she's absolutely right. Debit supplies 2,500. We credit accounts payable 2,500. That's how accountants and bookkeepers would talk to each other in this case. Okay. The debit to supplies means we have more supplies. Supplies account increases on the left side, which is the debit side. Accounts payable increases on the right side, which is the credit side. Again, offsetting debit with credit. Two accounts are affected. One account's affected on the debit side. The other account's affected on the credit side. Right? That's always going to be the case. Okay, nice job. Thank you. Event number 9, again, we hired people. Again, so in this case, and you're going to see this, and some people still get tricked. I don't know why you hire people. You promise to pay them $1 million. I don't care what you did. If you didn't give them the cash up front, there's no accounting. You'll do the accounting when you pay them. You don't do that before. And so in this case, it doesn't matter that we interviewed, we hired, we promised to give them the world. It doesn't matter. There's no accounting that we do until we actually pay them. Then we're going to do accounting. Event number 10 here, we paid a dividend. Dividends are usually paid in cash. So when we pay a dividend, we have less cash. And dividends take away from from retained earnings. So in essence, we have less retained earnings. So who would like to talk to me like an accountant on this one? Again, I'm hoping for new and exciting voices that come on board. Emily?
You're gonna debit cash by 500 and credit.
That tells me I have more.
What?
So when I hear a debit to
Oh,
cash,
I'm sorry, credit the cash for 500 and debit the dividends for 500.
excellent. Yeah, that's correct. So did you hear what she said? Again, when we have less cash, it's on the credit side. Dividends, like expenses, are on the debit side because they shrink retained earnings. Okay, good. And the last event here, we paid those employees $4,000 in salaries and wages. So that was a salaries and wages expense for $4,000 here, right? So the more expenses you have, the less retained earnings you have. And of course, people are working for cash. There's no other way to do it. And so we have less cash. So Ricky, are you there? Can you help me with this? Christian, are you there? How about Anthony? Is it time to wake up from your nap?
I can do it.
Thank you. Go ahead.
Credit to cash 4,000
Yes.
and debit to wages expenses 4,000.
Okay. Yeah, the debit's going to be the salaries and wages expense. Excellent. That's the name of the account. That's what we have to say. Perfect. So, well, let's just say it. Congratulations. You're learning. Today was your first step in learning how to talk like accountants by understanding that accountants look at all these accounts that have two sides. And one side of the account increases it. The other side of the account decreases it. It's just a matter of they're kind of all jumbled up. Assets, expenses, dividends are all increase on the debit side. More assets, debits. More dividends, debits. More expenses, debit side. Okay. Liabilities and stockholders' equity, including revenues, all increase on the credit side. More liabilities, we credit that account. More revenue, more common stock, we credit those accounts. So this is why I was mentioning that you kind of have to know you want to keep this type of thing handy when you're looking at this stuff to help you understand how an account is affected, because this is basically what we're going to be doing. So I'm going to bring us back to the main Zoom meeting. Ask if there's any questions.